Hello, Propenomix people, and good morning to Property and Properties people as well tuning in. So, welcome to another Sunday supplement. And this week was called Fairness with a question mark. And I'll be interested to hear your views as we go along and if you watch on the replay as well. So, if you haven't watched before, I'd like to start with a quote. And this week's is intergenerational justice, intergenerational fairness and equality is going to be the issue of the next 10 to 15 years. Is this generation, my generation, going to do right by the younger generation? Ed Miliband, January 2012. So as you can see, 10 to 15 years later that we're talking about this. And this week's quote is straight to the deep dive, and I believe gives a good grounding for the thoughts that go into the main report analysed in there this week from the Joseph Rowntree Foundation. Buckle up, because it's a hard read. But before we go into this week full hammer, Rob Turner and I will be running our property business workshop on Wednesday, the 1st of October in London. The subject matter this time is investment, with an emphasis on what metrics you really need to be considering to run your property business properly and building your business to scale. We're digging into the real fundamentals of property investment for growth, from proper valuation and strategic debt structuring to the investment metrics serious pros use. Hint, ditch ROI and yield. Learn why some deals work for some and not others, how to manage risk as your portfolio scales, and when to shift gear from side hustle to scalable business. We'll break bottlenecks, build strategic pillars, and unpack real-life case studies of fast company growth. How have we done so many deals? Well, we'll tell you. This is your last chance to book the super early bird tickets with the 20% off the face value now at bit.ly/PBWEIGHT. And there's also a link in the comments here. So, let's plough on with Trumpwatch, because rarely is it not an event-packed week. Now, Trumpwatch in general, and the supplement more broadly, has an economics-focused view. Recent weeks and months have had a more political bent, which has been a bit unavoidable. When the summer silly season is with us, politics is just more in focus than economics. But it's impossible to let this week pass without commenting on the assassination of Charlie Kirk. And Trump himself has certainly been vocal on this. Now, as usual, my commentary will try to provide something that I haven't seen out there, and thought of the more recent political assassinations in the UK sprang to mind. And whilst Kirk was not an elected official, it's very difficult not to describe him as a person of significant political influence who was directly involved in political campaigns. In the UK, one MP on both sides has been killed in the past decade. You will likely remember Jo Cox's murder, shot and stabbed outside her constituency surgery by a far-right extremist with links to neo-Nazi ideology. You might remember it because of the amount of coverage there was, but it was June 2016, around the time of the referendum. Sir David Amess was also tragically murdered during a constituency surgery in 2021, stabbed by a radicalised Islamist extremist. More recent, and most certainly well covered in the news, although my sense would be that Cox was covered even more extensively. But neither of these murders shook the world anywhere near as much as Kirk's, perhaps because of his online presence already, or there could be other reasons. I looked at Google Trends to see if I could confirm this, and I used all three names as search terms. For those who don't know how Google Trends works, it indexes everything. So if we compare Donald Trump to Andrew Tate, for example, the most searched person has an index value of 100, and the second most would then have an index number below 100. So let's say it was 50, it would mean he was being searched for half as much as the other person. So I limited the area of search to the UK, so it takes out US searches. I compared, now Kirk scored 100, Cox's index when the murder happened was 12, and Amess's was just 6, just after his murder. So Kirk is currently searched for 8 times more than Cox was, and 16 times more than Amess, roughly. There may be some time before the search data settles down because it's so fresh, but that would certainly be my sense of just how much it's captured the attention of the nation. All three events will always remain a tragedy of equivalent standing. Moving back to the economic side of the fence, the tariff judgments that will take place in November have been back in the headlines of late. If the tariffs that have been ordered under emergency powers or executive order, as you will have seen mostly, are ruled unlawful, there would be major refunds due, equivalent to between 0.5% and 0.7% of US GDP, to a whole variety of companies, some of them quite small. So it'd be the equivalent of fiscal stimulus, basically, to those companies. The likely reaction would then be more tariffs, you would think, that would comply with the law, changing the frame of everything again. But in the meantime, Mr. Trump is just ignoring all of that and continuing to reference tariffs such as 100% on India and China because they've been purchasing Russian oil. There's also open commentary around unwinding or revisiting trade deals with the EU Japan, and South Korea. I don't know how you do a deal if you're not going to honour a deal, but there we go. The macro figures haven't looked great in the US. A huge revision downwards in jobs created, and everyone was expecting a downwards revision, but not 911,000 jobs from the last fiscal year. The context was there was supposed to be about 1.8 million jobs added for the year, so 911,000 just cuts that in half. Other revisions of note included a revision downwards for June 2025 to show a loss of 13,000 jobs in that month, and that's the first monthly decline since December 2020. US unemployment at 4.3 is still doing better than UK unemployment of 4.7, but it's been a better figure than the UK over recent years, so neither are particularly out of kilter. And if anything, relatively, the UK number is a little bit worse in context than the US one, but it's fairly close. Growth expected in the US for this fiscal year has also been revised downwards significantly to 1.6%, with sticky inflation, some of which is simply factually linked to tariffs at the moment. That growth forecast is from Fitch and is well down on previous years. But low growth compared to recent times, 2.8% for the previous fiscal year in the US, but not incredibly out of line with forecasts for the next decade that are largely suggesting around 1.8 to 2% growth per annum, real GDP growth per annum in the US from the major forecasting houses. The Trump proposition, of course, would there be more than this because it's part of the deal, right? The position, I'm sure, will be blame the last administration and there's better to come. But Tariffgate could have a similar global impact with a different incidence and framework in 2026, the way all of this is playing out, if that's what the law is going to do. What about interest rates, though? Well, of course, this drags down near-term expectations of interest rates, and the Trump administration will point out, they've said this emphatically all along, get the rates down to 1% has been the rallying cry. They're holding the economy back. All of this macro data puts more pressure on the Fed to make a 25 basis point cut next week, and the market probabilities currently show that as a racing certainty. There's a small school of thought thinking 50 basis points or a jumbo cut, as they call it in the States, but the market gives a hold of the rates no chance whatsoever. This move has been what's moderated bond yields worldwide, including ours, because the US has so much influence over the rest of the world's monetary policy. But I'll close the section for this week with the observation that Trump's upcoming state visit to the UK is attracting significant attention in terms of trade policy and sparking discussions in tech, nuclear and whiskey particularly. We could do without tariffs dominating 2026 trade policy, but there doesn't seem to be another plan at this stage. Rule one way illegal and we'll find another way is the implication from the overall chatter. The overriding of the congressional system using executive orders suggests that even if midterm results are weak, this wouldn't particularly change anything when it comes to this sort of policy by this method. And of course, midterms won't take effect until 2027 anyway. But okay, back over this side of the pond, back to the real-time UK property market and Chris Watkin. He delivers once more because week 35 is now in the can. Listings printing 36,800. It's always a bumper week after bank holiday, so no surprise. And my 10% more stock than a normal market is still pretty much working on the back of 2 years of overperformance in listings compared to historical averages. August did calm down a fair bit, even compared to 2024. But, you know, we're 10.9% ahead of the 9-year average, but I do worry about the 2020 figure being included in that because it wasn't a real year by any stretch of the imagination. But we've really been drawing back to the 2024 numbers now because we were 6 or 7% ahead above them at certain points in the year. But we're listing more than we're selling, as always, or as almost always, not necessarily in 2021. Although it's all eyes on the withdrawal rate as a general rule. We're only 3.3% ahead of the 2024 listings now and 10.7% ahead of the 2017 to 19 average. Back to over 20,000 price reductions a week, though, for week 35, 25,700. But August's completed number was only 11.1% for reductions in the end, much lower than the 14.1 print in July, 14% in June. Last year it was 12.1, May 13.4, 5-year average of 10.7. Now, this might be something to do with the fact that certainly we tended to hold off on price reductions in August for stuff we've got on the market, because why bother? The market's quiet anyway. Do it first weekend back, first weekend schools are back and things like that. Whether agents are advising their clients similarly, I don't know. I just know what we're doing in my operation. Is that going to be, is it 25% more properties reduced than a normal market? I think it's an underestimate, probably, actually. I've been using that as a ready reckoner for a few months now. But the amount of stock out there, it's more likely that more than a quarter of it's been reduced, actually. we're still at around 90 to 95,000 price reductions in the last month. So if you can't find a deal, just keep the legwork up and you'll get there. You don't see 13% plus of stock being reduced in strong markets by any stretch. Holiday slowed things a little, but sideways pricing is continuing. And of course, we know from things like Rightmove that listing prices were a lot more realistic in August, but they always are. Let's see what happens in September's figures. Anyway, nearly 24,900 homes sold subject to contract, another rebound after the bank holiday, but not even an average week. The 2025 average is 26,200. Now, it is back to school week, so people go at different times and things like that. There's a big distraction there, generally speaking, for many, many families. So again, wouldn't read too much into that number being below the annual average, even though we had a bumper listing week. In listings, you see someone else is doing the work, aren't they, realistically? When you want to buy a property and you want to make an offer and you want to get it sold subject to contract, you're heavily involved in that process. So there is a difference there that I hope you can see. Sold subjects are up 6.3 year on year and 13.7% up on the pre-pandemic market, and are still nearly keeping pace with 2022, which is just about starting to cool at this point. We're coming up to the point where that disastrous mini budget was introduced. That'll be a few weeks until that's in the figures, and you'll see it at the time because I'm sure Chris and certainly myself will be commenting on it. But with sold subjects up 6.3, but listings only up 3.3, this to me signifies more intention to transact than 12 months ago. I say intention because sold subject to contract is not completed, but we know that fall throughs are roughly where they always are, so there's nothing really to take away from the fall through rate. It just looks like a more functional year for the market than 2024, even though stock numbers have continued to rise. So we've seen very little movement in prices, but ultimately we've seen more transactions happening, is how you would frame that. And then we went into September with the number I've been waiting for, 736,333 homes on the market. So that's 25,000 homes down on the number on the 1st of August. Now, I'm not going to draw too many conclusions because it was August and listen to what I've just been saying, but normally September the 1st number is not a drop, and it's certainly not a large drop like that. So perhaps we're past peak listings in this market, but we need 2 or 3 months to really establish a trend. And will there be a consistent trend? We don't know. We need more sales agreed for that to happen, and or fewer listings, of course, or we need a lot of withdrawals. A lot of removals from the market, I should say, rather than withdrawals as in deals falling apart. We're talking things coming off the market altogether. So more sales agreed would be needed, but only 24,900 sales agreed in the past week, but nearly 37,000 listings. You wouldn't expect that 736k number to have gone down in the first week of September, bearing in mind back to school rules, as I've said. Now, for a bit of context, before the market got stickier, before the pandemic, we had about 660,000 on. So we haven't, we're in our 10% range in terms of more stock, but we're coming to the lower end of that 10% range. We've had sort of 10 to 15% more. A seller's market is more likely to be under 600,000. At the end of August 2024, 710,000 were on the market. So we're not that far ahead of where we were last year, about 25,000 ahead, which is the amount of net withdrawals we had last month. So could be a clear out. But normally we see a lot of listing in September. So let's see what happens to September's number before we jump to too many conclusions. Now, Chris also uses the pricing per square foot. There's a very strong correlation between this and the prices that hit the land reg in 5 months' time or so. But this time around, August dropped to 338.78 a foot, 1.41% ahead of last year, 14.25 ahead of 5 years ago. So less than 15% ahead as a market in a time where you've seen much, much larger inflation than that. So real drop in real terms in terms of sold subject to contract house prices. We're down 2.2% on June's number and 1.75 on July's number. This is a dramatic drop, and it might well revise our number for the year when the figures hit the land reg down into the more like 1.5 to 2% region for 2025. Now, as I say, 5 months tends to be the lag point. So you're looking at July and August figures particularly closely. So around about 2% is probably the bullseye for where you throw the dart at the moment for house price increases in 2025. It's not an exact science like that. The correlation is very strong. It's over 90%. Now, I think I put this down to August plus stamp duty noise, really. But imagine if Halifax or nationwide had revised by that sort of number, down 1.75% in a month. I mean, all hell would break loose. 0.1% drop gets a million headlines about the housing market is coming apart because you've got so many people with vested interests waiting on the sidelines, hoping that the housing market will drop in value without any real reasoning as to why that would happen, any macro or any other reasoning as to why that would happen. But it's a big real times haircut in property prices over that 5-year period. The vast majority of that haircut will have happened between sort of 22 and 24, but it seems to be still relatively going on at the moment. If we're up 1.41% on August 24, sold subject to contract price per square foot, and inflation is currently 3.8, for example, then that tells you where things are. It's retreated another 2.5% in real terms. But I've been saying for years now, houses are very cheap in real terms. No one is really listening to me, and most people don't believe the figures, even though all I do is use all the macro official data from the ONS and the likes. So fall throughs trickled back above the long-term average of 24.2. They printed 25.8. So there's still been very little volatility around that long-term average for weeks now. There's a bit more noise than most there, but we've got to bear in mind the bank holiday catch-up and all the rest of it. Net sales only hitting 18.5k, so still 5.3% ahead of last year to date, and 10.1 ahead of the pre-pandemic market. Not quite 2022 levels, but we're only 14,000 net sales behind now. And I know we're going to get there by the end of the year. It's basically a guarantee, folks, because a lot of net sales fell apart. We went very, very quiet around the time of the mini budget in 22. So anyway, I always give Chris a weekly shout out here, exchange a few messages with him a week these days, which I'm very happy to do. Very privileged to do, because he does a lot more than just this epic tome that he releases weekly on the UK property market. He comes up with great stats on a nearly daily basis. So drop him a like, a follow, a subscribe, and all the rest of it, and some kind words for his content creation. He's on LinkedIn. I connect with him through there, and these days through the phone. But if you're in the industry and you want to support growing your business, and you want to be a more effective communicator, be more in touch with your local market, that's his core business. So give him a shout. His article gets published every week on the Property Industry Eye website, and the video on his YouTube channel at Christopher Watkin. Okay, over to the macro. Any gilt quakes to report this week? Well, I'm going to be looking at the Halifax House Price Index, the RICS Residential Market Report, and then No-wth, as I'm calling it, instead of growth, the GDP figures. And then it's out with the seismograph, as usual, to look at the gilts and swaps. So, Halifax. Bit of a different story from the Watkin one and the nationwide one, because Halifax reported growth of 0.3 for August, so 3 rises in a row for them. And it's a new high at Halifax with an average property price at 299,331. You can imagine the headlines when that hits 300k, can't you? They've got the highest average of all the major players, and on their numbers, that's 2.2% up for the past 12 months. They also highlight the average price being paid by first-time buyers coming down and affordability improving in their headlines. And that Northern Ireland is pressing on with the strongest regional growth, as it has been for a long time. And the north-south divide is turned on its head in terms of capital growth, with the northeast leading the way. The head of mortgages talks of stability, which is another way of saying largely sideways pricing, I guess, and a gradual downward path of interest rates for 2 years now. Again, I point out that isn't really the case for 5-year rates at all, but there we go. They do point out the encouraging sign of 65,000 plus mortgage approvals in July's figures, as I reported on last week, on the basis that summer is normally quieter. And I think that's a very fair shout, to be honest. On Halifax figures, they only have average house prices up £600 since January. Amanda Bryden also refers to many competitive fixed-rate mortgage deals being below 4%. It's been a rocky couple of weeks on the gilt, so that timing isn't perfect, but it just about holds water. Halifax has got the average first-time buyer property down 0.6% since May. And they suggest average repayments on a 30-year 95% mortgage could be 1179 versus 1343 average private rent. I truly hate this comparison, as you'll know, because you're forgetting buildings insurance, maintenance, compliance, longer-term running repairs to the structure, etc., etc. But there we go. When we go to the home nations, Northern Ireland is up 8.1 year on year, compared to Scotland at 4.9 and Wales at 1.6. The northeast, the northwest, and Yorkshire and the Humber are all up 4% plus in capital values, compared to a drop of 0.8 in the southwest. That's the first Halifax regional drop since July 24, which at that point was the east of England going down 0.2. London is up 0.8 year on year by comparison. July, via the HMRC figures, showed 1.1% more transactions than June and 4.3% more than July 2024, and also 4.6% more mortgage approvals year on year and 1.2% more month on month. However, they did note the RICS Residential Market Report showing buyer inquiries and sales agreed at negative balances. particularly sales agreed, showing minus 16% on the balance. But that was last month's report rather than one I'm about to analyse, although it doesn't get any more cheery in the one I'm about to analyse. So what about this month's RICS report? What did they go? They led with sales market activity continues to slow. How do they conclude that? Well, new buyer inquiries down, well, it was August, right? And a decline in sales agreed, which we did see play out in the August numbers, as I've already said, none of which is unexpected. They also report house prices drifting lower at the aggregate level. And I sympathise. They've got to produce a report once a month. It's all a bit boring if they just say, well, it's August. So, people are paying good money to access these reports and the analysis with them. If they just say, well, everyone's on holiday, it's not really good enough, is it? So we get it. But anyway, I think we need a little pause because they report house prices drifting lower at the aggregate level. So cheaper houses are transacting. More expensive ones are not, really. That's been the pattern since mid-late 2022, but it's becoming more and more exacerbated. And there's been more reasons for that. Some of it has been overall government policy uncertainty. It would be unreasonable to conclude, given that business has told us through the PMIs again and again and again, we're worried about government policy. And we're seeing that again because we've got a budget coming up where we're going to see some fairly significant tax rises, right? So if businesses are thinking like that, remember, they are made up of individuals, right? Then it's only reasonable to think that households and individuals might be thinking that as well, worrying about where tax might go, especially if they listen to some of the more sensationalist stuff that appears in some of the more right-wing media. Let's face it. This is not a party political broadcast for the Labour Party. Tax has gone up, but tax went up for years and years and years and years. Tax has gone up since 2015 as far as landlords are concerned in a major way. So this is no different for the drift just because the colour of the political party is different. Not a lot's changed. It's not like the Tories cut taxes, right? Let's not pretend that they did. Now, I think you've got to be very, very careful with the data if you're going to look at aggregates. If cheaper houses are transacting at 10% more than they were 3 years ago, then that's a real number that I've used from examples that I'm looking at this week in my own portfolio. It's about 9 or 10% over the last 3 years, right? Now, in all that time, the macro data is saying prices are only up 3 or 4%. Well, what's correct? Well, it depends on where the house is, doesn't it? But at a macro level, obviously the macro data is correct, but it's this huge blend of North and South, Scotland, Northern Ireland, blah, 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 all the stuff that I regularly talk about, right? But it's difficult, and I've highlighted this problem exists in all macro data aggregation. Just add everything together, and you're often going to not get to the root cause of reasons for the issue. You're going to miss things. But anyway, let's go ahead with the report and the conclusions that RICS draw. They report cautious near-term sentiment. Yeah, I'd say, okay, comes under sideways for me. The balance number, which is the big one that everybody looks at on the basis of this report, if they don't read the report, is minus 19%. Now, that's pretty bearish. That basically means about 60% think the prices will go down, and then 40% think that they'll go up, which leaves you with that would leave you with minus 20. So that's roughly where you are, right? Now, I'd expect a low negative number at the moment, and that is where it's been for recent months. I think 20%, 19% is pretty bearish, right? New buyer inquiries down 17%, though, on last month's survey. Sales agreed balance minus 24. So again, more bearish. The next 3 months, minus 2% is the prediction, right? Next 12 months, only plus 1% down from plus 8%. This is in terms of sales and transactions. So pretty bearish stuff, right? That's the worst reading. That plus 1% is the worst reading since October 2023. There isn't great optimism for the next 12 months. I've got to be honest at this point, I think that's wrong, right? I think they're not taking into account the changes that have been made to financial stress tests and things like that. It's like talking about a recession that's not here yet before it ever arrives, if it ever arrives. Anyone who's been listening for a long time will know we spend probably 80% of the time we're talking about recession. I'm normally talking about other people predicting it, not me, but 80 or 90%, it doesn't happen. And quite often over the last few years, I've been pointing out to you couple of little blip micro recessions, technical recessions, that haven't really made any difference anyway, and certainly aren't necessarily truly correlated to the housing market anyway, right? Big events, there's always an element of correlation, but these little statistical noises, not really so, right? Market appraisals, the balance is minus 7. Now, if we get into that minus 19 number and went regional, East Anglia, the balance is minus 64, and in the southwest it's minus 46. And we've been hearing about how the southwest, particularly in the Halifax data, is down year on year. So, it hasn't had a good year, and the way that surveyors respond to that is expecting it's not going to have another good year. That's basically what's happening there. It's not really much more than that, I don't think. Next 3 months house prices, minus 20% is the balance. So that means that's that 60% thinking prices will go sideways or downwards over the next three, and only 40% think they might go up. Plus 9% is the next 12 months in terms of what they think on prices, and that's the least elevated reading since December 23, when we know what happened, right? What about lettings, though? Well, tenant demand on balance is only plus 5%, which is a minimal change, but landlord instructions printed minus 37. That's the most negative reading since April 2020. Rental increases balance for the next 3 months, plus 27%, and the actual number that those survey respondents expect is 3% growth at the national level over the next 12, right? Okay, onto the No-wth part. Well, recent growth figures, in fairness, for context, have been pleasing. And we know the PMIs picked right up in July and then printed really, really strong numbers in August. So it seems only ironically fitting that it would be a 0% print for July. June was pleasantly surprising and even eyebrow raising at 0.4%. So I wouldn't read a lot into it. And I wouldn't necessarily expect the PMI month on month to track exactly to the growth figures. People who are writing in July's PMIs may well be talking about what happened in June and what they were thinking of for July. Do you know what I mean? They tend to do the surveys fairly early in the month. So I've never lagged it by 1 month and looked at the correlation, but let's see. August PMIs were so good, you'd hope it wouldn't be 0% for August, but we'll see those numbers in a month's time. The strong services prints are being tempered by terrible production figures, down 1.3% in the last quarter, and construction output, which is drastically different again from the PMIs, is still showing an increase of 0.6 in the last 3 months, although that is rowing backwards. Monthly numbers there are services up 0.1, construction up 0.2, but production down 0.9, which led us to the zero. Our annual run rate is still 1.2% growth per year at the moment, although the print based on 12 months ago is 1.4. So this is the difference between quarter-on-year comparisons and year-on-year, but don't get lost too much in those weeds. 1.3 would probably be okay as a proxy figure, but the official figure that's gone out there is the 1.4%, which is higher than pretty much anyone thought we were going to get to this year, actually, apart from in their initial hopeful expectations for growth, maybe last year from some of the bigger forecasting houses. Services continue to drive the economy, with human health activities up 2.5%, scientific R&D up 3.4%, and computer programming consultancy up 3.2%. And those are just the last quarter. So you can see where the boom industries are, and I don't think any of those would necessarily really surprise you. What struggled? Motor vehicle repair down 1.3%, education down 0.2%, and public administration down 0.2%. Now, you'd think you'd see that one as a positive. Is that something to do with efficiency savings? I know no one can get too excited about a 0.2% drop, but still, cheaper public administration has probably got to be a good thing, smaller public administration. But these last points are a bit of a nuance that's worth labouring. What I'm saying there is not all growth is good, and GDP is often criticised as being a poor metric. But the truth remains it's probably a least worst rather than a good metric. It does at least capture inflation, so it's real. Where the money goes is not captured. GDP per capita makes a little inroad into getting closer to the facts on that. But of course, it doesn't measure inequality, which we're going to be talking about in the deep dive a little bit. What about storing and warehousing? They got a mention for July. They did seem underneath everything to be a bit of a rebound in consumer spending. So there was good growth in that sector. And perhaps it's reflective of that consumer confidence rebounding. And look, we started from a relatively low base. It's being financed by outsized credit card usage at the moment. Nothing to go mad about, but 8% increase in credit card use year on year is not sustainable if your income isn't growing 8%. I think that's probably fairly self-evident. The doctor's strike gets a mention in passing in the report because it was in July and it impacted GDP downwards slightly, but nothing, they couldn't claim 0.1% or anything by any stretch. The travel agency tour operation bombed over the 3-month period, perhaps because the weather was so good in the UK, there was limited need to chase it abroad. I don't know, but I'm sure overall costs as well are still playing a big part of people's household budgets and financial decisions. Why did production crater? Well, almost entirely manufacturing. What else was down? Utility supply, mining and quarrying. The only notable growth sector was water supply, sewage and waste management, which is up 1.6. Where were the notable production drops? Pharma. You might have heard some of the noise this week around pharma investment in the UK not being viable. AstraZeneca have paused a project, put some political pressure on, it seems, with the budget coming up. And it's all about the NHS not paying enough. But of course, the pharma companies would say that, and it's really probably what we want to hear if we're worried about the healthcare budget, which we need to be because it's so utterly gigantic and growing at an outsized rate. But it's not playing. Is it playing out in the growth figures? Maybe a little bit on the pharma sector, but computer, electronic, and optical products, which I've not really heard about. Right, both dropped about 0.5% just in July. Yeah. Particular noise around AZ, as I've said, and also you will have heard Jim Ratcliffe's Ineos, I'm sure, pulling out of the UK in terms of further investment in energy infrastructure and energy trading markets and the likes. Construction new work is still 3.7% below January 23, but repair and maintenance is 17.7% up on January 23. And I've noted this in recent supplements, a definite lurch towards the secondary market, whether that's me talking about right to buy replacement, whether that's talking about investment property in general, whether that's me talking about funds who are looking at the secondary market rather than build to rent, that are not hitting their numbers, or urbans become unviable due to the Building Safety Act and related issues with high-risk buildings, which I'd like to say at this point is a poor phrase because the data shows they are absolutely not high risk by any sensible measure of risk. They are higher risk, but the use of the comparative seems to have escaped the regulators. And it's just a bad framing overall anyway, because it's pretending that there's any high risks to start with. The risks are just not high. And this is a bit like this when it says, it might be that if you have a bacon sandwich a day, you've got a 70% higher chance of getting cancer. But in the first place, the chance of you getting cancer from your diet might be 0.1%, and instead it becomes 0.17%. So the risk is higher, but there's no high risk involved from doing that, right? I appreciate those aren't the real numbers. It's just an example from the top of my head, right? So 1.4% per year, the most favourable number, but also the one there is consistency in using this 12-month number. Haven't seen it used much in the news outlets. It's there in the news outlets that are sympathetic to this current administration, which is probably only the Mirror these days, and the Guardian are still comfortably on the left, of course. But this is in the same week when Rachel Reeves suggested, when she got tied in knots a little bit, that the economy is stuck. And when you look and hear about regulation in general, the promise of cutting it really has been very limited to planning and financial services. And in many eyes, don't go far enough on the former. And I'm sure we can find plenty of bankers who'd say it hasn't gone far enough on the latter. Although I'm not so sure about that one. There's plenty of people on the other side of the fence with memories of 2008 saying we need to be careful with financial deregulation, of course. Okay, over to the seismograph and the 5-year UK gilts. An up week on the yields in the end, in spite of the negative US news, but largely we followed the US pattern. We opened at 4.058 on Monday, closed at 4.111 after a late drift upwards. Thursday's close was 4.047, so we had a fighting chance of a down week, but it was not to be. The 5-year swap on Thursday closed at 3.702, so still showing that sort of 34.5 basis point discount, keeping those mortgage rates below 4% for Resi on the best buy and on the lower loan to value deals, and keeping the number for buy to let limited company at around that 5.7 mark, or a shade lower from the deposit taking challenger banks. That yield curve still looks steep though. The lowest yielding gilt at the moment is the 3-year, although everything apart from the 1 year is more expensive than it was 12 months ago. The 30s this week actually had a down week on yield, which shallowed the curve slightly. They opened at 5.517 and closed at 5.502 after a promising Thursday close at 5.439. Still, shallower is more promising. The drift upwards in the shorter term on Friday seems to have been based on weaker sterling, based on limp growth, but the aggression with which the 5-year yields raised suggests some lumpy bets that rates aren't being cut particularly soon, which was my overall starting point for 2025 predictions, if you recall. We know the Bank of England isn't cutting rates next week, but are they in November? The more recent figures are saying between 30 and 40% for a cut, which I still think is too high. I'd still say it's more like 20% at this point in time, given what macro news we know is coming down the pipe. But let's see. Last week, it sounded like Armageddon. Gilt yields dropped. This week, there was very little noise and gilt yields rose. Easy game, this, isn't it? So into the deep dive we go. And it is a long one, folks, so please buckle up for this one. It's a nice mix of reports I wanted to tuck into. We didn't get many reports for August, and now suddenly we've got an absolute swathe of them. So if I don't cover a fair few, we won't get through them at any point. UK Finance have chucked out a number of reports for September with a bit of a whistle-stop tour, but the meat is the report from a Joseph Rowntree Foundation, which I don't think you guys are going to like very much, to be honest, but it has got some solid conclusions in it. Some of them are a bit egg on face, however, I suspect because the authors are not on top of the real-time figures for things like rent rises. But it's a good piece of work for yesterday's world, and I'll be fascinated to see how the conclusions play out and how long the conclusions play out for as well. Well, the ones that aren't inherently biased anyway. But as an aside, for a bit of context, the ONS updated their data on renter affordability this week, and August 2025 showed 30.1% of household income being spent on rent overall. That's the average, right? Not the median, the average. The highest number since the ONS began using the data loft data to produce this series back in 2017. Now you're going to see some related contingencies here. The ONS sees the benchmark at 30% for affordability. So on average, rent is now classed as unaffordable, right? So we can't say more than half of households are paying unaffordable rent because it's not the median, it's the mean. But agents, for as long as I can ever remember, have considered either 33 or 40% the affordability thresholds, or 50% in London, for as long as I can remember, and I'm sure back before my time. So the arbitrary nature of the affordability threshold can be debated. What can't be is that rent is taking up a larger percentage of renters' household incomes than it has for some time. When I went back into the ONS annals, I found that in 2005, for example, which is when the ONS rent data set started, before they were using the data loft data, rent was actually comparatively much higher. But this never gets publicity since it doesn't suit the overall media narrative. Just as an aside, right? 9th of July 2023, my most self-referred to supplement, all the analysis is in there if you want it. Cheapest for 20 years, the article was called, and it's on my LinkedIn. Back from the aside and just onto the UK finance stuff. 4 reports since the holidays were over, and a whistle-stop tour of them. Business Finance Review, about business. Card Expenditure, about spending. Household Finance Review, about household finances. And Later Life Mortgage Lending, about equity release. So the Business Finance Review is from Q2 this year, and it was the 6th quarter running where lending saw growth, and it's now 8% a year growth in business lending from an unsustainable 14% last quarter. But remember, after COVID, this is all coming back from a low base, so we're not seeing some kind of, disgraceful credit expansion that's going to cause a bubble or whatever, not at this point. Anyway, the slowdown is in lending to medium-sized firms as it goes, a UKF report. Net lending still inching towards positive territory. So in Q2, it was still net negative, as I've reported on in the Bank of England Money and Credit Report on a monthly basis, which is a little bit ahead of UKF's general releases. Now, small companies reported positive news around lending, 28% up on 1 year ago, quarter on year, and further increases in new loan approvals. But further new overdraft approvals, fewer new overdraft approvals, based on concerns after the national insurance contributions increase, and also just worries about broader cost pressures. Total deposits still fell, but at the slowest pace for around 3 years. Instant access business savings have been run down. Deposits are 20% below where their peak was. Now, there's some large sector differences here. You can probably imagine for yourself. Hospitality versus computer consultancy firms, going back to the growth report above. Overdraft utilisation rates were static, with repayments down slightly this quarter across all sectors. Modest growth, stable delinquency levels were the conclusions, with business being cautious and cost-conscious, with subdued demand for borrowing to invest from SMEs. The 3 issues cited are international trade risks, fragile consumer confidence, and uncertainty on government policy ahead of the budget, which all sound pretty fair to me as far as concerns go. Card expenditure for Q2 saw limited change from a year ago in value terms, so inflation has eaten away at that, of course. The growth was in food and drink spending and other retailing, and most service sectors saw a fall. So once again, UKF reverts back to sluggish consumer confidence and cautious discretionary spending. Flat spending, 3% more transactions. So consumers are spending the same as they were 12 months ago, but they're shopping around more and more, making more lower value transactions. The average value of debit and credit card transactions is therefore down 3% on a year ago. Guess what? Contactless transactions are on the rise, as are online ones. No real news in there. What about household finances? A dip in spending in Q2, increased inflation, mortgage lending went down sharply, but we can't read anything to that because of the stamp duty cliff. Growth in June suggested to UKF there would be forward momentum on mortgages, and we've seen that from the Bank of England figures as well. They talk of no sustained growth in refinancing, although I think I see 10,000 more loans per month being refinanced compared to last year. Now, remember, when the Bank of England do their sort of remortgage figures, they're looking at people who have gone elsewhere as it is. They're looking at people who've stayed with the same provider to remortgage, because that's what the reporting's about. So if it's a more price sensitive market, it doesn't necessarily capture that. So I do have to trust what UKF say. So fewer are on standard variable rates. They've either given up waiting for what they wanted, or they've got what they wanted, or they've realised things aren't going down much more, and they've just fixed anyway. Household savings continue to grow, and remember that's absolute terms, not percentage terms, because we know we went down from 12% to about 10.9, I think it is, in the savings ratio, but still incredibly high in context of before the pandemic, say. Mortgage arrears also fell again, possession rising modestly, still catching up on the historical arrears. And then the final piece of interest in summary is the UKF take in the conversation around lenders being allowed to take more risk in the mortgage market. Under current conditions, allowing more lending at lower stress test rates would result in an additional 175 arrears cases for every 10,000 additional loans granted, or 1.7% bad debt if you prefer. This analysis is far from robust. They see it as linear, and based that on the current bad debt rate on loans they're paying above the stress test rate over the past 10 years, right? So they do admit that they don't take into account the more permissive rules would bring in higher risk borrowers anyway, which of course it would. But they do note that looser criteria would also bid house prices upwards, affecting affordability overall. But they also appreciate that would be a very small percentage of additional lending. So in other words, there wouldn't be that kind of impact anyway. It'd be very, very little impact. I don't think you can really draw a lot from that. It's a very, very basic piece of analysis, but I guess they've got to say something to throw into the regulatory debate here. How about later life lending? This is borrowers over 55, in case that makes you feel old or young. 33,130 new older borrower loans in Q2, up 0.5% year on year. 5,830 were lifetime mortgages, which is up 3.7% year on year. Just over £500 million advanced on equity release there, up 10.6 on a year ago. 305 loans were retirement interest only. So if you want to start a mortgage lending business, I wouldn't necessarily be going into that 305 loans a quarter. Sounds quite thorny to me, and that's probably why it's such a niche area. But I wanted to report on this because I still believe equity release is badly underutilised estate planning tool for those who have estates smaller than 5 million. Just to throw a dart at a limit in there. If you've got more than 5 million to pass on and you haven't got proper advice, go and get proper advice, for goodness sakes. If you've got less than 5 million, but you've got enough to pay the 40%, the 40% should be driving you to use equity release sensibly and not worry about the debt rolling up within your house. Unless you've got a particular and specific plan, or you've got only one beneficiary, the house will likely cause issues anyway after you're gone. You need to be really sanguine about this, in my view. It's not one size fits all, but the tool is still badly underutilised to opt a decent slab of your net worth, usually out of IHT, and turn it into liquid cash with no cash flow implication each month. They can't take the house off you until you go into care if you do. Again, you might be better to control that situation than not, but that's a whole other topic. Okay, on to the Joseph Rowntree Foundation report. Now, the JRF is a charity conducting and funding research to solve poverty in the UK. Obviously, it's a creditable cause, although I do have pedantic issues with the definition of poverty and whether it's relative, which is normally an arbitrary line of 20% below the median, or absolute, in which case I'm very, very keen on being able to solve absolute poverty. It's a great idea. But as a stupid example, if the median person has got a Lamborghini, but maybe in the real world, flat screen TVs and the latest iPhone or whatever, 20% below that might really, using the word poverty, I just don't think is a reasonable thing to do necessarily. But then a lot of stats and macro is about arbitrary lines. So there you go. I personally would focus on absolute poverty. But anyway, the JRF don't necessarily make that distinction in anything that I've read of theirs. This report is called Rebalancing the Housing Market Through Tax Reform. and talks of reforms introduced in 2016, marking a decisive shift in housing policy, reducing landlord demand and freeing up homes for first-time buyers. Now, they don't put any political capital or credit on any of this, although it's obvious to anybody who remembers anything that it was George Osborne's 2015 budget, which led to the introduction of these things in 2016, that really marked a huge U-turn in how the country were feeling about buy-to-let landlords, or how the government was feeling about them anyway. So you can see a little bit of their agenda here. They want to shift towards first-time buyers, and they're claiming that landlords are clogging things up for first-time buyers. Although you could argue that their argument is demonstrably true, because if you do get lower demand from one sector, buy-to-let landlords, all else being equal, economically it has to mean the price goes down for everybody else, and the beneficiaries of landlord-suitable stock are likely to be first-time buyers. But here's a bit of a longer explanation, because this is where I struggle a little bit on a personal level, right? I think you need one, right? For every house I've ever bought, pretty much, yeah, and I'm nearing 1,000 purchases and sales combined these days, right? Many investors, including listeners here, don't compete with first-time buyers at all. They buy wreckers, as they're often fondly called, or problem properties that are often not financeable with traditional finance methods. I'm not saying first-time buyers never buy a fixer-upper, many do, although more and more don't, would be my anecdotal feeling. I'm talking tenanted or really problematic, unmortgageable, uninhabitable, auctioned off, fire-damaged, blah, blah, blah. Killing demand from that sector, for example, by making additional stamp duty 8%, as it is in Scotland, is very different from putting off people from buying houses near London where there's overwhelming tenant demand. But I can guarantee you that the latter have been put off by nothing more than the normalisation of interest rates between 2022 and today, right? The maths doesn't work anymore. Policy changes had an impact, but as homes got cheaper in 2021, 5 years after these reforms started, investment demand was roaring because buy-to-let finance for limited companies was available below 3%, right? The current 5.7% market price, as I discussed earlier on, just takes out so many properties in lower yielding areas, almost all of them to buyers who are going to buy with leverage. But anyway, that's my couple of points of order to give this some context, but let's press on. I understand my own business model is not necessarily anywhere near reflective of amateur buy-to-let, particularly in low gross yielding locations. The first sentence of the summary made me chuckle, even though I do agree with it. A recent, though relatively under-discussed aspect of housing policy has been the use of the tax system to dissuade buy-to-let acquisitions, and in doing so, boost the position of first-time buyers, FTBs. Why did I chuckle? Well, if I had £1 for every time I'd heard someone talk about Section 24 and the deep unfairness of it, but I understand. I'm not a normal person. I chair panel debates at property shows, for example, about this sort of subject. I would say that Section 24 is overrepresented in this debate versus formerly 3% and now 5% HRAD, as it's called, higher rate additional duty on buying buy-to-lets. And obviously Section 24 only discriminates against individuals in favour of limited companies and other wrappers as well. And you'll very quickly realise where the JRF lands on this. They crack on with these reforms help level the playing field between landlords and owner-occupiers. Now, here is where the pedant in me falls out with them. The playing field before Section 24 was that first-time buyers could avail themselves of a 95% mortgage versus 75% for a landlord. Or let's be generous and say 80% for a landlord instead, although there wasn't a lot of that out there before 2016 necessarily, post-2008. So first-time buyers needed a deposit that was 1/4 of the size, let's say. Advantage FTBs, right? But landlords could deduct the mortgage interest relief plus agency fees, compliance costs, repairs from any income they made from the property, compared to the FTB being in the same position as if they rented. They pay their mortgage from the net income. There's no real interest only available to first-time buyers. There was to landlords, and there still is. They pay lower rates than landlords, though, but no benefit other than capital growth and certainty or control, or however you want to put that part of owning your own property. Although, as I've said before, rent versus mortgage is not a valid comparison. It's a rough guide. My opinion, you should actually gross mortgage payments up by about 35% if you were going to make them comparable. But then, of course, what you'd have to take into account is that, as I said, not much interest only available, particularly 305 retirement interest only mortgages in the last quarter, for example, right? Not much available at all. So what you're doing as well with repayment mortgage is a forced savings plan. effectively for 30, 35, 40 years, depending on how long the term is these days. So again, you are putting that money into a wasting asset, which is appreciating only if you look after it, basically. So definite points to landlords for being able to use interest only. More points to first-time buyers for having lower rates, and then the utility piece, an investment and a backstop for a landlord, a pension pot, something for a child, a roof over the head for a first-time buyer. It gets very difficult to quantify. You could call it a score draw with the first-time buyer perhaps a little bit still in front. Now, the first-time buyer is usually much younger with much less capital, and so fairness across generations gets to be a very hard metric to measure. So let's not say level the playing field. It's a lie. Let's say tilt the table a little more in favour of the first-time buyer. Some, if not many landlords, could even get behind that, I'm sure, altruistically. First-time buyers should have an advantage. Otherwise, the game stops, right? Any landlords with children with aspirations of buying a house would be in favour, I'd imagine, purely for self-interested reasons. But for me, when stamp duty on HRAD went from 3% to 5% on additional housing, I just knew I would do fewer deals and the vendors would take most of the incidence of the new higher rate. My offers would go down accordingly. That's exactly what's happened. And so I buy fewer records and problem properties now than I would have done and than I used to, because the marginal deals go to someone else or they stay unsold, empty or derelict, etc., etc. Rant over. The claim then from the report is that these contributed to helping, bit weak you'd think, more than 1 million households accessing home ownership. I hope they're not suggesting that for 1 million houses that otherwise would not have been bought by first-time buyers were then bought by first-time buyers, because that feels like an impossible position to take, frankly. But we will find out. They then say that concerns about potential downsides to renters, namely higher rents and reduced affordability, have not materialised. The publication of this report in the same week that the ONS published the worst affordability metrics since the advent of these tax reforms appears a little ironic. Both can't be true. Of course, I'm not blaming higher rents and reduced affordability solely on this either, but to state that they haven't materialised is a bit of a giggle and is simply not based on the figures. You'll work out why, because they're using old figures as a general rule, which is quite common in these reports. Then they say what I just wish they'd said in the first place. Several reforms since 2016 have focused on strengthening the position of first-time buyers, recognising that landlords with ready access to borrowing and capital have been able to outcompete residential buyers and drive up prices. Now, I agree, again, that amateurs might do this, right? I'd contend those amateurs probably wouldn't last that long because no one overpays like a first-time buyer. That's why house builders concentrate so much on them, of course. But it's hard to evidence without aggregated data on properties where first-time buyers have competed with landlords. And I don't even know that agents would have data like this. But if anybody does know, please set me straight or let me know. For what it's worth, I always choose the first-time buyer. I've sold more than 100 properties on the open market. Why? They're much more motivated, they're much less fickle, and they're much less likely to try and chip than a landlord. And that's just my anecdotal evidence. JRF then go back to pointing out the approach of strengthening first-time buyers, whilst also simply raising more tax revenue, which has been the angle for the government, certainly in the move from 3% to 5%, in my view, with the first-time position strengthening being no more than a bit of a political bonus. It's unpopular with landlords and their lobbyists, who, hang on a second, they are few and far between, they are fractured, they are poorly capitalised, and they're not really lobbyists compared to, for example, the oil industry or the renewables industry as it goes. The lobbyists cited include Property 118, claiming an exodus of landlords. Sadly, the JRF does not bother to include the figures, which show a huge drop down to half the number of available properties to let in 2024 compared to 2019. But presumably they've got some alternative figures. I'm a bit confused by the denial approach, I must say, at this point in time. In 2021, you'd have had a great case for denial, right? Which is why, in truth, a lot of this is mostly balderdash, because it's interest rate normalisation that has driven the recent changes in the market, primarily in my data-based view. Although there is a very good graph in this report that I've shared on the LinkedIn side as well, which does give their conclusions some pretty serious weight. It's just what's happened in recent years and pretending rents haven't gone up that I can't get my head around. It's just not true apart from anything else. But they do finally now mention interest rates here, blaming it all on the lettuce. Now, I don't want to sit in a glass house and throw stones here, but I first warned of inflation in Feb 21. It broke out in August 21, and it was well underway by the time we got to September 2022. Now, look, old salad face made it a lot worse, much more quickly. Of course she did, right? But she wasn't the root cause of the entire thing. Remember, gilts calmed right back down to below 3% on the 5-year in Feb 23, before they then hit 5% in July 23. And Liz, long gone Liz, was long gone by then, right? So it made me chuckle, because that's about the most biggest defense of Liz Truss I've ever done there. There we go, don't get excited. It makes me chuckle because they then go on about simple and compelling narratives, which is exactly what they're constructing themselves, totally ignoring the data up to this point. But they do admit that the actual impact of fiscal reform on home purchases into the PRS is less clear and has been subjected to limited analysis. Conclusion, they don't read the supplement. And they wouldn't like it much if they did, I dare say. But anyway, no analysis, they say, has meaningfully considered what happens to renters when rates of home purchases in the PRS contracts, or when the overall stock of homes in the PRS contracts. Once again, still, I can tell I'm going to enjoy this one, right? Their conclusions: fiscal reform has dampened demand from the PRS, flatlining the size of the sector. It's not a mega conclusion by any means. Chris Watkin has produced graphs to this effect for years. I've done similar in terms of my own analysis. The size of the sector, the PRS, peaked in 2016 to 17. Little regard is given to any population growth since then or demographic changes. But let's see if the JRF really is different, right? What's that claim again? 1 million more owner-occupiers than if the trend preceding 2016 followed, who would otherwise be living in the PRS. I'm looking forward to it. There's been little impact on those who do remain in the PRS, apparently, and those impacts that exist can be managed by policy and regulatory intervention, apparently. That's the typical conclusion of the left, of course. But their ultimate conclusion: tax changes have been a success and have rebalanced, continued to tilt, as I prefer, power in the housing market. And there are viable changes to pursue. And this is the best way for the government to support more households into home ownership, apparently. So what can't we argue with? A meteoric rise in the size of the PRS between 2000 and 2015. Of course, this is outside of the rest of the context. So, for example, no mention of the social sector and lack of replacement of rights to buy. But their data point, what they selected, is true. They've cherry-picked 2000 because they know the data. So I don't know why you wouldn't pick the advent of the Housing Act 88. I don't know why you wouldn't pick the advent of the buy-to-let mortgage in 1996, but they haven't, because they want to make the best point they can. So the PRS grew from 2.1 million to 4.8 million in 2015. That is huge. 2.7 million extra homes, more than doubling in size in 15 years. No one can argue with those facts, right? That is huge. They give a little mention to the social housing stock, but they don't provide the numbers for context. They ignore the numbers in general. They mention affordability scoring on rents, not incomes. Well, hold on a second. Is that fair? I mean, I'm not convinced, right? Let's say, remember, you can borrow 80% of the rent as far as mortgage payment goes, or you can borrow on 4.5 times your income. So if rent is 30% of income on average, that's the ONS number at the moment, as we've said, lower according to them, then borrowing on rent is 80% of 30%, right? 24%, or 4.17 times rental income. So it doesn't actually hold up as an advantage at all. It's more the use of somebody else's household income to then score for rent, to then use as a mortgage payment. That's actually what they've got a problem with. But that's ideological. It's not there's no fact of the matter advantage in here anywhere. But this is where, when ideology gets in the way, that's why it needs to be called out. Prove it with the figures, or disprove it with the figures and change your mind. Up to you, right? But anyway, they follow up the tax point with a convoluted graph, which misses the point of a lot of Section 24, that you get into the tax bracket based on the gross before the 20% relief is applied. And so many with one property and a basic income are pushed into higher rate threshold when they're not higher rate taxpayers and beyond. I was going to use it as the image, but I can't really tell if the analysis is correct on that basis. They omit that point, so I've got to assume they don't understand it or haven't researched it sufficiently. So I'm really unsure. But what the graph does say is that the percentage in gross rent going in tax, so gross rent, bear in mind, right, turnover, we would call it in any other business, has gone from 7.8% for basic rate taxpayers, 15.7% for hires, and 17.6% for additionals, which is wrong for the reasons that I've already said. has gone to 24.2 for higher rate and 28.3 for additional rate. So they haven't tried to encapsulate just how many more people have been pushed into the higher thresholds by Section 24. Pretty hard to conceptualise because tax on turnover is what's being done, and there's no comparable in any of the business, as everybody knows. But what we can say, if we accept the JRF figures, is that the tax incidence for higher rate taxpayers is up 54%, and additional rate taxpayers is up 61% when we look at the relative move. So quite a hike, as I'm sure you'd agree. And if you've gone from a higher to an additional, or from a basic to a higher, those percentages are even higher, and they're more like 100+% if you've gone from a basic to being a higher, just because of the way Section 24 is calculated. And that's just a share of income, right? Not an absolute figure. So if rent had gone up 20% in that time, obviously you're paying 20% more on top of all those extras. So the marginal rate is easily 60% more tax than you were paying before, right? If not more. They then estimate 20% of landlords have been affected by these changes. It's poor analysis to prove a point here. And I don't think they care anyway. They don't care about landlord fairness. So I don't know why they even try to bother, really. But what we should be saying is what percentage of tenants have been affected, JRF. It's self-evident that the more properties you have, the more you would have been affected, right? A fifth of landlords are affected, but 80% of landlords have 1 to 3 properties. The 20% that have 4 or more would control far more than 20% of the rental stock. The figure doesn't prove anything, right? They don't care about tax fairness, as I've said. They care about giving the younger and the poorer a better chance of home ownership. And I'm not necessarily arguing with that standpoint moralistically, but we need to understand what they're producing in that light, of course, right? It's context. So, income tax and Section 24 done as far as JRF are concerned. What about the higher rate of additional duty? Right, remember, it was a double gutter ball introduced in 2015, but actually came into law 1st of April 2016, from 0% to 3%. They estimate the average landlord paying $8,500 on a purchase, up from $2,000 before the change on stamp duty. Now, they assume a landlord pays the same as a first-time buyer, because that's the whole premise of their argument. Landlords and first-time buyers are competing. Now, I think it's a false assumption, but what I did at this part was I actually did the work that they should have done, which is go and look at the HMRC figures, because they know what people pay in higher rate duty and all the rest of it. And actually, before roughly at the 3% level and the 5% level, as far as we can tell at the moment, the average buy-to-let purchase is £260,000. Again, I struggle a little bit here because my average purchase would be less than half of that. I don't know how you buy at 260 and make money. I'm not going to lie, unless it's worth 400, in which case obviously you're going to make money, right? But I don't know how people do in general. But I think they're just looking at it as long-term investments. They're dumping money in. They're not getting great returns. They're getting single-digit returns, and that's part of the problem. I wouldn't get involved in buy-to-let if I was making single-digit returns. I don't know why you would put that effort in, take that risk, and all the rest of it. But that's why I don't. But it just rankled me slightly that this is just, we assume this, so we're going to do it. I just don't like that type of analysis, really. But we're also going to need to see what happens with the reintroduction of the 125,000 stamp band, because that, again, pushes things up again, something I've spoken about in relation to some of the Hamptons reports I've analysed recently, apart from anything else. What about tax removal of advantages on short-term lets? They don't talk about the wear and tear allowance being taken out, but they do talk about short lets being outside of the scope of Section 24 and coming back in. They also talk about the CGT being moved from 28 to 24, was framed as boosting the availability of housing by encouraging residential disposals, which makes sense. I think if you wanted to encourage disposals, you would cut for 3 years, right? You wouldn't cut permanently, you would cut for 3 years, because that would encourage transactions over those 3 years and cut from 24 to 20, let's say, but just a point of order, really. That's what the Treasury have been saying this year, even though it wasn't them that did it. It was Jeremy Hunt that did it. But there's a few things confused here, right? They think that a freeze in the supply of the PRS is a good thing, and you might be able to get on board with that. An increase of 2.7 million from 2.1 is utterly excessive. There's no debate about that realistically. But if there is an excess, and that excess is run right down, as is evidenced by the example of the number of available properties plummeting, would it not be reasonable to theorise the low-hanging fruit has been plucked, and further tax changes, which there's just not the data yet to analyse properly and objectively, even if anybody wanted to, might have an adverse effect? Now, this really comes down to, do you need a functional PRS or not, of course? Some ideologues believe that you don't. All property is theft. Yawn, yawn, yawn. there's limited thought given to the transition from where we are today to where you might want to get to, even if it would happen, right? It's a bit silly because recent rent increases have outstripped or really just lagged inflation, which they do. They lag by 2 or 3 years. I mean, literally, you can see the inflation curve shift to the right for rent inflation. It's not rocket science by any stretch. But we've got to give credit to one graph in the piece, right? I do want to mention correlation and causation here, and they really don't say much around the inflection point around 2008 when lending criteria tightened up massively. I don't know how they can have this conversation without talking about giant policy changes on lending that happened between 2007 and 2012, for example. It really damages the credibility of their argument, but this is a one-horse argument, and that's why they do it that way. I did use it as this week's image. You can check it out on my LinkedIn or on the Property and Propenomix website. Thanks, James, for hosting it on there. From a textbook perspective, what's going on here from an economic standpoint is landlords, before the changes in 2015, were making what was called supernormal profit, right? The sector could survive with people making a normal profit. That's what most things happen. There's competition, things get bid down, rents get cheaper because there's lots of stock, blah, blah, blah. But there we go. Why do they use 1990 as ground zero in the graph? Well, not the worst year to start from the owner-occupier perspective. Pre-BTL mortgage, post-Housing Act 88. Really tough few years for people in recessionary times. And rental stock indeed dropped over the first few years as the recession continued to bite. But you can see when it really picks up after the buy-to-let mortgage went mainstream. It's very interesting for me to note the financial crisis didn't knock the growth of the private rental sector off at all. Now, what's not been said here is that there was a huge growth in the private rental sector from amateur landlords at that point because they couldn't sell their houses, but they didn't need to move on, right? So lots and lots of people kept a house and rented it out. I did it myself, and many, many, many households did that. So that was forced upon us to an extent because we had two choices: take a loss, sit and wait. And loads of us who could afford it chose to sit and wait. They don't mention that at all, but never mind. That's possibly the reason why around the financial crisis, things don't stop growing particularly. But then, of course, that effect might last 1, 2, 3 years. But then what about between 2010 and 2016, 2011 and 2016? Still needs looking at, right? I'd say then, if you're asking me, one of the things you take into account is the amount of money that flowed into London that was cash. Over £100 billion in cash for property purchases. Not all of which were rentals, of course, but that money being pumped in flowed through the market, through the sector, through the economy in general, right? Now, there's a difference. 1990 to 2002, the PRS lines are very shallow. Then it starts to move up at a real pace. Owner-occupiers are moving up at a good pace and then get their wings clipped, as I say, by big policy changes in the GFC. There's no yardstick given to that. It's all being blamed on the PRS. And as I say, people who didn't even want to be strategically in the PRS who found themselves in there. But there we go. It's hard to draw a formal conclusion for the graph other than JOF present part of the story, and it's a compelling part of the story, right? The PRS flatlines ultimately, and the owner-occupier graph moves up at a 45-degree pace. You can't deny that. That has happened since 2016. Recent mortgage underwriting changes, as encouraged around the stress test, will also help first-time buyers more. There's no two ways about it, right? Is that as charitable as I'm going to get? I think it probably is. I don't like the 100% correlation implication that's brought about when other arguments should be being discussed, quite obviously. But the final part of the graph post-2016 is pretty compelling. And it might not just be about tax. It might be a hostile environment towards landlords overall. Again, a more full and real discussion that was really interested in the truth would have to include that, right? Difficult to measure, difficult to evidence. But they don't really care about what they can't evidence. They just say it as if it's true, which is what a lot of analysts do, in fairness. So when we get into the weeds, there's a complicated but pretty reasonable looking, actually, multiple regression model. I'm not going to spend lots of time talking about it because I don't think you want to hear about multiple multivariate regression models. But what do they conclude? Interest rates explain most of the variation in real new buy-to-let gross investment. There we go. Average income tax levels have a smaller but still significant impact. It's funny that I had to go into the analysis of the regression, which I'm sure they're expecting pretty much no one's going to read, and pick that out of the detail. But, it's funny they don't frame their conclusion like that when yields were decaying pretty much all the way through 2010s. Buy-to-lets were still benefiting from that, even as taxes did change. However, tax rate changes were stark enough to kill off the sector growth. And then when interest rates the other way, as they were always going to at some point, it really turned the screw. Although the data hasn't gone far enough to really evidence that as yet. And where they get their rent conclusions from, I just don't know. They then mention a bit about ISAs being relevant, but they assume landlords will compare putting the money in a building society to what they might get from a buy-to-let, and they don't really care about anything else like the stock market and stuff like that. Again, not a terrible conclusion, to be honest. But the next graph is an eye popper. I haven't included that one. It's figure 11 if you want to read the report. Landlords make a loss in all of 2023 of over 10% of rental income. And they're basically breaking even before Section 24, but losing on average about 12% of rent roll after Section 24 is being taken into account. That went from a 30% of rent as profit position in 2021. I don't know if anybody listening would agree with that necessarily. We've never hit 30% margins, but we're reinvesting so much that it's very difficult for us to measure that margin as a general rule on cash flow. So now some numbers I've not seen before. In 2010, one property landlords owned 40% of the stock. They now own 20% of the stock. 2 to 4 property landlords own 30% by 2024, up from 20% in 2010. Landlords owning 5 or more properties owned 40% of the stock in 2010 to 50% in 2024. Now, they're a little bit round, a bit like the iconic Rowntree's fruit pastel, but they come from the English Private Landlord Survey. I've not seen this attempted before, but better than nothing. It's a survey, right? It's not a measure of what's actually happened, and I'm always cautious about that. But in fairness to the JRF, what else can you use if you can't use the English Private Landlord Survey and the English Housing Survey? These are the benchmark bits of data collection that do need to be used, even if they are survey results as a general rule. Now, what they don't mention, because it doesn't fit their narrative, is that in 2010, 11.4% of properties were owned by landlords with portfolios of 100 or more. But by 2024, that number was 2.6%. So major portfolio holders hold less than a quarter of what they did. Now, that's a big deal. It's a shame they miss details like this because it puts all of their conclusions into question, right? Then there's a bit of analysis on the amount of supports provided by the government. It doesn't really distinguish on what was helpful or not help to buy. The lifetime ISA first-time buyer bonus, Bank of Mum and Dad spiked during 2021 when the market was booming. But actually, when you look at it, it's not doing that much more business than it was in 2009-10 in terms of helping people out. They've tapered down Help to Buy without hurting first-time buyers, which isn't spoken on much. That means the government is spending less, although it's not necessarily spending when it's guarantees. But Help to Buy funds were spent because they were going to the developer. Then they were just coming back in the frame of repayments and, of course, corporation tax on profits, you could say, as well. So onto the bit the JRF might be rather annoyed to be cited on in future, and I think in the bit I look forward to the most. This has all not affected rents. Their words, not mine. How do they evidence this? Median expenditure until March 24 is down on rent for the bottom 40% of income-earning households. The next bit, there was no real-term rental growth between 2016 and 2021. Now, that's true. I shared a graphic from Chris Watkin earlier this week that shows real rents down in London and the South East, not all around the country, from 2016 to the present day. Rent rises since 21, which, of course, the JRF does acknowledge have been sharp, are for reasons beyond tax reforms. I'd agree. High levels of inflation and earnings, according to the JRF, they don't, again, really annoys me, completely ignore the argument about the higher cost of delivering the service, but part of basic economics is left out because it doesn't fit the narrative. But it's all driven by higher interest rates and the stark normalisation that's gone on. Back to the old days. We then talk about 20 to 34s going back to the year 2000. As I've discussed before, we go from 20 to 25% of people going to university to 50% over that time period. But if we don't move the age at which we do the analysis, you've polluted the sample. An extra 3 or 4 years out of the working life of 25 to 30% of people in that sample are going to change when you can buy a house. And going to change even more recently as you're paying back massive student loans, right? That should be self-evident, but I've been deep into that argument before and I'm not going to do it again. What about the homelessness? Well, according to the JRF, they cite limited data. We can all see the amount being spent on temporary accommodation rocketing upwards, but they sadly don't bother to cite section. They would call section 21 the cause, not having other root causes. They miss the point that more and more PRS properties go into providing homelessness support cover and via a provider or otherwise, and it's completely lost in the macro figures. One day, one of them will get it, but don't hold your breath. They speculate then on what the PRS will do next. They want parity between tax, investment income and work. And many people won't like this either. The fact is there isn't much of a reason not to charge PAYE income tax. So basically scrap employee national insurance, and income tax is 28%. There's not a good reason not to do that, guys, I'm afraid. But it is what it is. Vote Lawrence? Thought not. Right. They also call section 24 on companies and call the company structure a loophole. It's a horrific mischaracterization of the circumstances. It's also largely without precedent and would, of course, encourage more to actively sell up and shrink the PRS, although the JRF would say that's a good thing because people will just buy those properties to live in. Delulu, as the kids say these days, I think. They then want ATED, the annual tax on enveloped dwellings on let properties. I've always said when ATED came in, this will happen one day. They'll use it for the rental sector. Higher value properties are more dangerous and susceptible to this. But the analysis is mental here because the entire premise is there's no concept of price elasticity of demand in rental property. Even though there's a massive body of academic work on this subject, it's basically the equivalent of putting your fingers in your ears and shouting, rent control works, like people did in Scotland when then rents went up 15% in a year after it was introduced, right? 60 to 80% in the academic research of massive increases in cost of delivery are passed on to the tenant. But it's a really scary idea using ATED. Could raise a couple of billion quid according to the JRF, and I could see it happening. It's one way of introducing Section 24 for corporations, which is another thing that they support, by the way, that equivalent sort of disallowance of debt interest or whatever. It'd be quite difficult to do, realistically, and there's very little international precedent for it. They do it in Germany for debts over £2 million, I think. Debt payments over £2 million, so for larger vehicles. But they want to contract the amateur PRS. Well, okay, fair enough. I've seen some really bad smaller landlords, but I've seen some bad larger landlords too. The small landlords who pay close attention to detail provide magnificent service to their tenants. When it's all owned by companies, I said before, it'll just go up 1% year on CPI plus 1 on January the 4th. Good luck with that. And then what are their assumptions? I just need to drive a quick truck through this. Yield at 5.5, whereas most places are showing 6.5 these days. Maintenance and management at 1% of property prices. So that's 18.1% per year. It might be okay, but it ignores rent arrears, bad debts, insurance, compliance costs. Big omission. They're massively overstating landlord profits in this report, and they assume a constant average rate of buy-to-let financing at 3.13%. Now, that's just so they can do the analysis, but I don't know why you're not using 5% these days, or the average payment that a buy-to-let landlord is making, which you could get from UKF if you were that bothered about it. They're trying to do that to isolate tax changes, but it makes a lot of it look like Swiss cheese when it comes to these percentage conclusions they make. And then when you consider, rent was up 7.7% to March 25. They've only got figures till March 24, and we're still up 5.9% year on year at the moment. So, saying rents haven't materially gone up at the moment is just silly. They just haven't in figures that are now 18 months old, folks. So you've really got to have a look. It was written by Joseph Elliott and Darren Baxter. Both are on LinkedIn. They posted the full report on there. They want to be cited as how tax reform has helped balance the housing market. As I say, tilt more in favour of the first-time buyer. But you might not necessarily have a problem with that. I'd rather we just call it what it is. So before I chip off now, just one more reminder, last chance to book your super early bird tickets for the workshop, bit.ly/PBWEIGHT. Folks, I've gone on too long today. Keep calm and carry on. Thanks for listening.